Hello and welcome to the Your Financial Pharmacist Real Estate Investing Podcast, a show all about empowering pharmacists to achieve financial freedom through real estate investing. I'm Nate Hedrick, and each week, my co-host David Bright and I explore stories from pharmacists all over the country who are achieving their real estate goals while maintaining a meaningful career in pharmacy. Whether you're a first-time investor or a seasoned pro, we're here to provide education and inspiration about the world of real estate. Please note, this podcast is intended for educational purposes only and should not be considered financial or investment advice. Hey, David, how's it going?
Hey, good. Thanks. How you doing, man?
Doing great. We're just living the dream in this summer, enjoying as much as we can on the hot days. This is the best time to be a Clevelander. So we get the sunshine a little bit of the year, and this is it. So
yeah, not only like the outdoor fun stuff, but all the outdoor, like I know on the real estate side, this is like landscaping and house painting and like all those projects that you can't really do
exactly
other times of the year, or at least they're so much better to do when it's like decent out rather than like 4 degrees out, you know? So
yeah, trying to fit it in when it's finally a nice day in the middle of winter, that's the worst.
Right. Yeah. Yeah, we've been out with the kayaks and all this stuff too. It's been a fun summer.
Good. Any I know we're talking today about some real estate projects you've been wrapping up. What's on the recent docket?
Yeah, we've got a couple of BRRRR projects wrapping up, which I feel like every time I say the word BRRRR, I have to like my inner educators like stop, like explain what BRRRR is, right? So BRRRR, for those that have been listening a lot, they're probably familiar more with the buy, rehab, rent, refinance, and repeat strategy, which is where you buy a property that needs some work, you rehab, you fix it up, you then rent it out, you refinance it. By the value you've created and fixing it up, you try to pull that back out through refinancing, and then hopefully you're pulling out most of your money and you're able to repeat that process. So that's what we've done for a lot of our real estate investing is this BRRRR model, right? The BRRRR model. And so that's been helping us. And so, yeah, this is definitely the time where we're seeing those, that remodeling work in the past few weeks. A lot of the really more tangible things too, like we had a roof on a property last week, had a property painted a couple weeks ago. So yeah, it's been fun.
Yeah, I love the BRRRR method, especially as a way to keep recycling capital, right? I think we talked about this in the past, but when we bought our first property, we did it the standard. It was actually about as turnkey as you can get, 25% down. Here you go. Great rental property. Still have it today. Love that place. But it was just, the cash reserves went from the investment property fund to zero. So the BRRRR method is nice because it allows you to recycle a lot of that capital, which is, again, a big thing for new investors, especially, or those that don't have as much capital to get started, because you can keep recycling it, which is awesome.
Yeah, not having to make that 25% down payment every time you buy a property is definitely a helpful accelerator for real estate investing. I know that there are still sometimes some slowdowns to that process. Like a lot of banks want to see a 6-month, they call it a seasoning period between the purchase and the refinance. So it can still take a minute for that process to complete, even if it's a pretty simple rehab, just because of that longer period as well.
And it's one of the big risks, right, with the BRRRR method is that if you're going to be refinancing down the road, you don't know what 6 months from now looks like, right? Are we going to be in an economic downturn, or are we going to be in the situation we are in today where interest rates are way higher than they were when we were buying property 6 months ago? So that is one of the downsides, right?
Yeah, that definitely has potential to shake things up. And in the past several months, like maybe a year ago, it might have been a really pleasant surprise, right? Because your appraisal might have come out higher than you were expecting, and interest rates may have been really low still. So sometimes there's pleasant surprises, sometimes there's unpleasant surprises, like interest rates being higher, or an appraisal could be lower. So you still do have to cushion for these kind of things that can happen. However, I know in very recent times here, like, yes, the interest rates have gone up, but we've also seen rents go up quite a bit in the last 6 to 12 months. So there is potential. One of the things that we've seen in some of the projects we're working on is it kind of comes out as a wash, right? Like we're paying more in interest, but we're able to rent the property out higher than we had initially anticipated. And so it ends up not really hurting us in the end.
Yeah, I think that's more the case for especially for you and I. We invest in the Midwest where the property values are a little bit lower, so that interest rate doesn't hurt us nearly as much. But and I'm also seeing some more creativity in the lending space too. I think there's been a lot more DSCR loans, or I'm seeing adjustable rate mortgages, for example, things that can help to bring down that interest rate during that refinance so that the project can still work.
Yeah, between I know the adjustable rates have gotten really popular lately. It seems, portfolio loans, but more than just that very traditional 30-year fixed rate conventional mortgage. I think
Right.
for those that have been investing for a while, I know a lot of people tend to jump right into the same type of loan that you get for your primary residence, that 30-year traditional fixed rate mortgage. But yeah, I think people seem to be branching out from that as we see some of these market shifts.
And so I think, as much as those options can be helpful, it can also be really confusing and overwhelming. One of the things that I deal with on a regular basis with my own clients is what kind of loan is going to be the right fit for me? What lender do I even go to talk to them? They're offering this, Nate. Does that make a lot of sense? It's like picking a medication for a patient, right? You need to make sure you know all the variables before you can just pick which way to go. So I think understanding that for your specific investment strategy, that's what I want to dive into today.
Yeah, and so as you mentioned, diving in, right? That's what we do every few episodes around here, right? Like we pause every few episodes and we take some question or topic that's brought up either in the YFP community or in a recent podcast, and we do a deeper dive to explore that a little more thoroughly than we're able to in a quick interview with a guest. So we keep seeing more and more questions about these loan options, and so we thought this is time to break down some loan types, talk about loan strategies, some loan terminology to make sure that as pharmacist investors start to think outside the box a little bit, you've got some of the lay of the land so that you don't get yourself in trouble.
Yeah, and I hope this is helpful for those that are newer or walking into a first refinance or a first investment property, because it is different, right? I think one of the mistakes that I made early on was assuming that it would be the same as buying a typical family home, right? A typical primary residence, but it's very different. And so understanding that, knowing at least a little bit to be able to ask the right questions, that's really the primary goal here.
Yeah. So the six terms and topics that we really want to take some time and unpack today are owner occupant versus investment loans, to your point there. We want to talk about amortization schedules. We want to talk about early termination or prepayment fees or penalties. We want to talk about what balloons are when it comes to lending. We want to talk about fixed versus adjustable rate mortgages, and then some of the different loan types: conventional, FHA, portfolio, DSCR, what all those different loan types mean.
So let's jump right in then. Let's start off with the owner occupied versus investment property. Again, something I deal with all the time. It should be fairly simple, right? The single family house that I buy for me and my family, that's owner occupied, meaning I'm going to be living there. Even if I go buy a duplex, right, that technically is owner occupied if I'm going to be living there. But where it starts to break down and turn into investment loan is where it can get more complicated. So David, where does that nuance, like where does that start to diverge into an investment property loan?
Yeah, I think the nuance is really tough there, and it makes sense. I think this is one of those times to call in an expert, right? And to just be very transparent with the lender that you're working with and say, this is what I'm trying to do. Help me with the loan that I need. Which you mentioned there about a duplex if you're going to live in it. We've had people on the podcast that have talked about the house hacking strategy. And that's where you buy a duplex and you live in half of it and you rent out the other half. Some people may buy a house and rent out bedrooms to friends. I lived in a situation like that where my roommate in college bought the house. He rented out to me and other guys, and so that was a great way to house hack a single family house. So when you are doing that, you can generally get an owner occupant loan because you are living there. And even if you choose to move out at some point, depending on the loan type, you may not need to refinance it. You may be able to keep that with that original loan, but not have to convert it into some kind of investment loan.
Yeah, exactly. I love that part too. I've had questions like that before, like, oh, Nate, when I move out, do I have to immediately refinance out of this loan? It's like, well, let's talk about what type of loan it is, because that maybe, but probably not. You might be able to just ride that loan out, which is huge. And so again, just knowing that what's nice about those loans is that if it's an owner occupied mortgage, they can be a conventional loan. And so even though it's an investment property, you still have a conventional loan type, meaning you can put less down, meaning you can get the lower interest rates. You might be able to purchase that duplex that the typical investor needs 25% down and has a 7% interest rate. You can get it with 5 or even 10% down and have a lower interest rate than that outside investor. So owner occupied can be really advantageous if you can swing it.
Yeah, and I think that's one of those key differences. We'll talk about rates and all those things in a little bit, but yeah, as you jump to a non-owner occupied or an investment property, oftentimes you see those requirements get a little tougher to meet, right? You're having to make a larger down payment, you get a higher interest rate, and that's because you're not living in it. It is an investment property. So if you are not going to live in it, there's rules around vacation rentals and like how often you have to be there in the first X amount of time for it to count as like a vacation home versus an investment home.
Right.
But as an investment property where you do not intend on occupying it, it is truly an investment. That's a different type of loan there.
And a good reminder that this is exactly why both of us, looking back, wish we would have done house hacking. If I had known about it back then, I would have totally done it.
Yeah. And so, yeah, with those investment property loans being harder to get, the owner occupied loans being easier to get with that lower down payment, lower interest rate. Yeah, that can be really advantageous. So next up, amortization schedule. So that 30 or 25 or 20 or 15 year term on the loan. Nate, can you walk us through that one for a minute?
Yeah, this one's fairly simple, but it's really important to just take a step back and understand it, right? So a lot of people are familiar with a 30-year mortgage where you have a 30-year window to pay off the loan. The payments are engineered in a way that you make the minimum payment, you pay off that loan exactly in 30 years, right? On that last payment, you might have a one small payment at the end, but you're going to get it knocked out in exactly 30 years. And there, of course, are options to reduce that period, right? You could do 25 or 20, even a 15-year loan is pretty common in the mortgage space. And generally, that shorter amortization schedule is also going to reduce your interest rate, right? The bank is giving you an advantage for paying back the loan faster.
Yeah. And so if you really are looking to pay down that property quickly or pay it off quickly, you can have that paid off rental property with an enormous cash flow. Oh, we've all heard stories of people that will use a rental property as almost a college savings tool.
Mm-hmm.
And so you might buy a property with a 15-year mortgage on it so that when kids go off to college, then that property is paid off. Like if you buy that when they're just a toddler, by the time they go off to college, it's paid off. That cash flow then kicks in and can help with college. So there are strategies like that out there. However, by having that larger minimum payment, then your debt to income percentage may be higher when you're applying for other loans. So that debt to income, or DTI, that factors in what's your minimum payment on all of your debt versus your income. And it produces that debt to income ratio or debt to income percentage. And so that can create hurdles if you're looking to buy more and more rental properties. Even if you can make that payment, that as that ratio gets higher, as that percentage gets higher, it looks a little more risky. And so it can be harder to get loans the more 15-year or the more short amortization period loans that you have. So that does push a lot of real estate investors to those 30-year loans at times.
Super important point you just made there, David. So I'll reiterate it, is that your debt to income ratio is calculated based on the monthly payment, not the total debt, right? The bank doesn't care that I have a $300,000 loan. They care that I have a $1,500 a month mortgage payment, right? That's what they're actually looking at. So when you shorten that window, you're raising your monthly payment, raising your DTI. And again, know that if you've got a 30-year rate or even a 20-year rate, you can pay it off at a 15-year rate. You can pay it off faster if you want to. The bank doesn't care as long as there's no prepayment penalty, which most conventional loans do not have a prepayment penalty. So you can pay it off faster, but you can't go the other direction, right? If you set it at a 15-year rate, you can't just backtrack. So it's a decision to be made and one that you got to kind of stick with, unfortunately.
Yep. And just as you mentioned, I want to unpack that a little bit more. So you mentioned the term prepayment penalty. So let's talk about that. Sometimes I hear this as prepayment penalty or prepayment fee or early termination fee. So what is that? When is that a thing? And how can that come back to haunt someone?
Yeah, super important question to ask your lender or to make sure you're reviewing your documents when you're signing up for a new loan. Basically, most loans allow you to pay them off at any time without penalty or any sort of problem. But some products, especially those that are geared toward investors, the bank is banking on you paying it off over a certain time period. And so they might have prepayment penalties or early termination fees. In other words, they're giving you basically a fee if you're paying that off quickly, if you terminate the loan early. And that can be because you pay off the property, or it can be because you refinance. It doesn't matter. If that loan goes away, you might pay a fee for that. These can be inconsequential, a couple $100s, or I've seen them be pretty significant. I've seen as high as 5% of the loan value as an early termination fee. Sometimes it'll be early termination up to a certain period. So let's say you have a 15-year term, and then they'll have an early termination clause if you close that loan within 5 years or within 1 year. So look at the clause, make sure you're looking at the details, but that can really make a difference and really start to add up.
Yeah, and so if you're planning to hold a property for a really long period of time, it may not be a huge concern. But particularly if you don't want to keep a property, if you're intending to just hold it for a couple of years, 3 years, you may want to be especially watchful for some of those penalties and things that may be in different loan types, especially if you've only bought owner-occupant properties, personal residence you've lived in. Again, like you said, those prepayment penalties don't often apply to the loans that we get for houses we live in, but they can come out of nowhere if you're not looking for them on investment properties.
One of the points of clarity, David, that I've gotten from clients before who are first-time home buyers or refinancing for the first time, for example, is what is the difference between a prepayment penalty and what is a balloon payment? So those get confused a lot. Can you explain the difference for us, David?
Yeah, that one, I know it came up back on episode 62, I believe it was, where we talked about loans that had balloons to them. And so the balloon is a point at which in the loan where the loan is due in full, regardless of how much that loan has been paid down. So for instance, some loans are built on a 30 or 25 or 20-year amortization, meaning that if you just make the minimum payments, it's not going to be paid off for 30 or 25 or 20 years. But you may have a balloon payment where that loan is due in full at either the 5 or 10-year mark or kind of common intervals there. So those loans are built with the assumption that either you're going to refinance the loan and start over with a new loan at that 5 or 10-year mark, where generally you'll have paid it down some, so you'll owe less. Hopefully the property is appreciated. It's gone up in value. You've paid down the loan. It's going to be even easier to qualify. But if the value of the property drops significantly, or if the bank is no longer interested in lending in that asset type, maybe that can create a conundrum there. So you want to be careful with these balloon loans unless you really have a plan of what to do when that balloon is due.
And just like we said before, at the end of that period, things may have changed, right? You can predict and plan and all that. And if you're planning to refinance, for example, interest rates may have changed dramatically. If you started off with a 5% interest rate 3 years ago, that was great, especially in like the commercial space or something. But now it might be 7 or 8 or higher. And so that can really start to impact cash flow. And so when we see these balloon loans, again, typically they're on the larger investment commercial side, think apartment complex, things like that. So generally not something that everyone's going to run into, but it is important to understand that those exist. And as people get more creative with refinances and investment strategies, you might start to see this. I've even seen this where lenders will group single family homes together on some sort of bundled loan product, and that bundled loan has a balloon payment. So it's not just in the commercial space. This is entering the residential world as well.
One thing is with those 5 and 10-year intervals, I know that 5 or 10-year balloon can often get confused with a 5 or 7 or 10-year ARM loan. So Nate, can you walk us through the difference between a balloon and an ARM when it comes to a loan?
Right. So balloon payment, again, is that the entire balance of the loan is due at, again, the 5-year mark or the 10-year mark. But when you're talking about an ARM, the only thing that happens is that your interest rate is adjusted, right? You're not due on sale or you're not due a bunch of money all at one time, but your interest rate is going to adjust, which is going to affect your monthly payment. So the whole ARM idea, think adjustable rate mortgage, that's what ARM stands for. There's generally a time period on that adjustable rate, right? Meaning that rate is locked in for a certain period of time, and then it's going to adjust at a given interval. And there's limits on how much that loan can adjust. They'll actually define those limits in the terms of the loan. It can adjust a certain amount every so often, and it can go up by X, and the maximum amount it can go up to is Y, right? That's all predefined in that product. And so if you hear someone talk about, for example, a 5-1 ARM, right, you're going to have something that adjusts every 5 years, for example, or it's going to be locked in for 5 years, and then it's going to adjust. And it might adjust every year after that. So there are lots of different products out there that have this type of setup, but that adjustable rate means just that. It's only affecting the interest rate itself.
Yeah, and I know this one came up on the Ask a YFP CFP episode 121, talked about adjustable rate mortgages as well. So definitely something to think about, because these loans seem to be coming back into style at the time of this recording anyway. So it can definitely be a temptation to get into an adjustable rate mortgage, particularly if you believe the rates are going to come back down at some point. But if if you are of the belief that rates could adjust up, that can be a problem. And that was one of the things that Blake and Zach talked about a few episodes back, is doing that kind of stress test on their math to see like, well, okay, if the rate adjusts up, or if we're forced to refinance at a higher rate, does this property still make sense? Are we still safe with this? And that can help to mitigate some of that danger.
Yeah. So the danger there, like you said, is that future scope, right? We don't know what interest rates are going to do in the future. We can predict and we can guess, but we don't know for certain. And so if you are stuck in that loan and they adjust up to a point where the math doesn't work anymore, that can really be, detrimental to your investing plan.
Yeah. So I think another option could be like, say, for instance, that you have a super aggressive pay down plan where you're getting a 10-6 arm and you're going to pay it off in 10 years. You're just going hard on that payoff strategy. Right. I mean, that could work, right? Like it's not going to adjust before you pay it off, but that's a lot of ifs. That requires a lot of things to work out. That's like no accidents at the property, no bad tenant situation, no roof you weren't expecting, anything like that. So definitely something to think about when it comes to considering an ARM loan in this environment.
Good stuff. All right. So then that brings us to different loan products that are out there that fall into these different categories that we've described. But for our sixth term loan types, let's talk about conventional, FHA, portfolio, and commercial. David, what are the differences there?
Yeah. So conventional is a very common loan type, and a lot of folks that buy a personal residence are buying with a conventional mortgage. So that's a Freddie Mac or Fannie Mae loan. That's, again, what most people get into for their primary residence. Just about any bank, any mortgage broker can get a conventional loan with very low interest rates, generally fixed rate, generally low down payment options. You do often have adjustable rate options. You could make a higher down payment if you wanted to, but lots of flexibility, very common. Generally not prepayment penalties or some of those other scary things as well. For investment properties, we're generally talking something like 25% down, lower interest rates overall, and amortization's really up to that 30-year mark. So whether it's fixed adjustable rate, at least you're not worried about prepayment penalties or balloons, making these generally steady and safer options for newer investors.
Yeah, very common, and steady and safe feels very pharmacist friendly.
Yes. Pharmacist friendly for sure with that steady and safe, which I think also brings in the FHA loan type, right? Like that's another one that tends to be that steady and safe, but there's generally a catch with FHA loans. So what are some of the things to think about with FHA?
Yeah, there are a few catches. I mean, the big one here is that you have to live in the property. So as far as an investment standpoint goes, I mean, that is a big difference. You cannot use an FHA loan for your second house or a property that you're buying just as an investment. You have to live there. The good news is, though, obviously, is that you can get away with a lot more lower credit score or an improving credit score, I'll say.
Mm-hmm.
And again, you can get away with a lower down payment too. That 3.5% down payment is great. But again, that big caveat that you have to live there. These will not work if you're buying a property that you're not intending to live in.
Yeah, so that's where that house hack strategy could work. If particularly, like, I tend to think of that pharmacist that's getting out of school, has a lot of debt, like they're in a tougher situation there, but they've saved up a small down payment. That could be one way to get into particularly a house hack situation, where if you're able to buy a duplex and have the other side essentially pay all of your living expenses, like that can be huge if you can not have to have a rent payment coming right out of school, so you can aggressively pay down loans or hit other financial goals. So the house hack situation can be a great thing with an FHA loan.
Yeah, as much as everyone likes to tout investing with low or no money down, which again is possible and doable, the reality is that the best way to do it with low or no money down, honestly, is owner occupant, right? Choose FHA, choose one of those options out there that lets you be an owner occupant. It's a super powerful strategy for getting in with lower upfront costs, but it's not a fit in every situation. You really got to stick with the owner occupant a lot of times with those.
Yeah, so that's conventional FHA, which tend to be owner occupant focused. What about portfolio loans? How does that fit into the mix?
Yeah, so these are generally loan types that they mirror the conventional or the FHA loan, but they're held by a bank, right? So again, without making this a 2-hour long podcast, right, the bank itself keeps this loan on the books rather than selling it off to Fannie or Freddie or some sort of other government entity or all the other options they have available to them. So the bank is actually holding it on their own personal books. And as a result, you're probably going to see a slightly higher interest rate, probably a shorter loan amortization limit, or maybe even a requirement that it's an adjustable rate, again, because it's a higher risk loan. It's something the bank is retaining on their own books.
Yeah. And then I hear often this question of like, well, why would anyone want like something that's the same as conventional except higher interest and, shorter amortization period and adjustable rate when you may not want that? Like, what's the advantage there? And then where I tend to see investors move towards a portfolio loan is once they've got too many conventional loans. I know for a lot of folks, there's a limit of 10 right now at the time of recording investment loans conventional that you can have. And so if you get that 11th property, like that may be the time at which you need to start looking at other lending options. And so if you're able to do something that looks similar to the 10 that came before it and do the 11th, the portfolio loan can make sense in that situation.
And I've also seen too, where if you've got a good relationship with a particular lender, sometimes their portfolio lending options can be really lucrative, right? If they know you, they've got a good relationship there, and they want an investor like yourself on their books, they actually might give you an advantage to using a portfolio product. So it can be to your advantage as well. So don't write that off. And then if none of that works, right, David? So if all of those things fail and you got that 11th property, like you said, then you can look at something like a commercial loan, right? So typically we think of these as things, not in a personal name. These are going to be used for commercial properties, like maybe a storage unit, a strip mall, even pharmacy buildings for our pharmacists out there. But you can use them for rental properties too, right?
Yeah, sometimes individual rental properties or packages of houses, and yeah, you may see kind of in this category different names for different types of loans. So maybe a commercial loan or a DSCR for a debt service coverage ratio loan. Like there's different ways that these may be termed in different banks or brokers that may have these. But then, yeah, those commercial loans, some of those rules, like any kind of 10 property limit or whatever that property limit may become in the future, those limits may go away. So, but then commercial loans are the ones that are famous for having prepayment penalties, balloons, and rate adjustments to them. Also generally shorter than 30 years, although there are some 30-year options out there as well. So it's hard to say that there's any absolutes with any of these because there's so many different loan options, but I start getting a little more cautious about what some of these options may be in the commercial space because there's just so many options out there. So if you are considering a commercial loan for, say, a group of single family houses that you have, or if you're looking at a strip mall or storage unit or something like that, that's where you really want to be careful. Make sure that you fully understand all the terms of the loan. You know if there are penalties or balloons or things like that to make sure that it fits with the strategy for the type of property and how long you intend to have that property.
All right. So I know that we have covered a lot in a short amount of time, and truthfully, we've only scratched the surface on loan products, but hopefully this gives you some at least glimpse into the different options that are available to you, and then you can go exploring the ones that might be a good fit for you. As always, if you've got questions about specific loan types or about something we brought up on this podcast, we'd love for you guys to reach out to us. Head on over to yfprealestate.com. You can connect with David and myself, or join the YFP Real Estate Investing Facebook group, a great place to connect with myself, connect with David, other pharmacist investors. Again, just because there's a lot out there, right? More information than we can possibly put into a 30-minute podcast episode about loans. So.
Yeah, but hopefully this can serve as that jumping off point so that at least you can ask some intelligent questions when you talk with that lender. You know kind of what to look out for, and you can start to position yourself well so that you can understand what you're doing and make sure that this loan is a good part of your real estate investing strategy.
Awesome. Well, hopefully you guys enjoyed and have a great rest of the week.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard on today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with Nate or David, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group. As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.